So, usually when we talk about a business being successful, there's this expectation of pure clinical precision.
Right, like looking at an X-ray or something.
Yeah,
Oh, hey, I think our listeners got something to say.
Yes, hello. The accounting information system. Could you please discuss the
Oh, go for it.
could you please discuss the AIS?
We'd love to. It's so great to have you joining the conversation today.
seriously, welcome in. Let's unpack the AIS, or the Accounting Information System.
Think of the AIS as the central nervous system of any business.
Here's where it gets really interesting. It's not just a fancy filing cabinet.
Exactly. It collects and processes transaction data and then disseminates that vital info.
Oh, yeah. Go on.
So is the accounting information system just like a um
Hey, yeah, what's up?
is it like a methodology or is it like actually like a system like a information system?
Oh, that is such a sharp question. It is actually a bit of both.
It really is. Think of it as the physical and digital infrastructure that implements the accounting methodology.
Exactly. It is the actual system, often electronic these days, that handles the heavy lifting of data.
It captures every event, like a sale or a purchase, and turns that raw data into something useful.
So it takes the rules of accounting and builds a functional house for all that information.
Precisely. It is the mechanism that collects and processes every single piece of transaction data.
Oh, yeah, uh-huh.
So then it's like a system of like servers.
Yep, go on.
So it's a system of servers as well as like information systems uh,
Oh, back to our listener. What's up?
like information systems, like all sorts of different like web portals, things like that.
Oh, yeah. Let's hear it.
Web portals, like automated data gathering, like whether it's internal,
Oh, go for it.
like this is internal information. This is an internal system, like right.
You nailed it. It definitely functions as an internal engine for the company.
It's fascinating because the AIS tracks both internal and external events that affect the business.
Oh, yeah. Uh-huh.
So like, what is like an important thing to know about the AIS?
Okay, let's unpack this because there is one super important thing you've got to keep in mind.
It's all about the basic terminology that makes the whole engine actually run, like the concept of an event.
Right, an event is just something that happens, creating a need for a entry or a post.
And if that event involves a transfer between two entities, we call that a transaction.
So those portals you mentioned, they're just ways the system captures these specific events and transactions.
Exactly. And the AIS sorts them into accounts, which track the effects of every single exchange.
Here's where it gets really interesting. We have real accounts that are permanent, like your assets.
But we also have nominal accounts, which are temporary and get closed every single cycle.
That's a great point, especially when we think about those internal portals you were talking about earlier.
It connects back to what we were saying about internal versus external events in the system.
An internal event might be something happening entirely within those company walls, like moving supplies.
Exactly, while external events involve interactions between the business and its outside environment, like a sale.
Even if the data stays inside those... Oh yeah, let's hear it.
So is it something just like an overview of what we know about what the system does, or do we have to know like specifics about the system?
That is such a great way to look at it.
It's actually a bit of both, honestly.
Okay, let's unpack this. You don't need to be a computer engineer to understand it.
Exactly. The focus here is more on the logic of the accounting cycle itself.
So while we aren't talking server specs, we are talking about those specific steps.
What's fascinating here is that even Dr. Hope calls this a foundational review.
Right, it's to help you if the system doesn't seem to make sense.
So knowing specifics like the journal and ledger helps you see the flow.
Those automated data points you mentioned earlier only matter because of the ledger.
If we connect this to the bigger picture, it's all about how information flows.
Even if the data stays inside those internal portals, it affects the whole picture eventually.
Because the AIS collects that data and turns it into information for many different parties.
Here's where it gets really interesting. It's all
Ah. Yeah, uh-huh.
So then, what is like the anatomy of the accounts, like real and nominal?
That is a brilliant follow-up. You've hit on the actual DNA of the ledger.
Okay, let's unpack this. The anatomy of an account is actually quite simple.
Every account is essentially a record that shows the effects of transactions on specific items.
Think of it like a bucket for every asset, liability, and piece of equity.
Now, your question about real versus nominal is where the timing comes in.
Real accounts are the permanent ones. They don't just vanish when the year ends.
Exactly. These are things like your cash, your buildings, or the debts you owe.
They stay on the balance sheet, carrying their totals forward into the next year.
On the flip side, nominal accounts are temporary. They're like a stopwatch.
Here's where it gets really interesting. Nominal accounts track things like revenue and expenses.
These are closed out every single operating.
Oh, yeah, uh-huh.
Okay, so like the nominal accounts are like contra accounts.
Oh, I totally see why you would think that. It is a really common mix-up.
It definitely is. What's fascinating here is that they actually serve two very different purposes.
Okay, let's unpack this. Nominal accounts are all about the clock. They're strictly temporary.
Exactly. They track things like revenues and expenses for just one period and then reset to zero.
Contra accounts, on the other hand, are more like a sidekick that offsets a main account.
Right. They show a balance that reduces a related account, like the allowance for doubtful account.
That allowance account is actually a real account because it stays on the books for years.
Whereas every nominal account must be closed out every single operating cycle to reset them.
It's like clearing a whiteboard so you can track the next year's performance fresh.
If we connect this to the bigger picture, this timing distinction is why the cycle works.
You dump all that temporary nominal data into retained earnings to keep the balance sheet updated.
It's how that ancient 500-year-old cycle handles everything from internal transfers to external cash.
And no matter the account type, the debits and credits always have to balance out.
Because if they don't, as the saying goes, the accounting world basically implodes.
Thank you so much for diving deep into the anatomy of these accounts with us today.
It's been a total
Oh, go for it.
And so like the temporary accounts,
Oh yeah, go on.
at the end of the accounting cycle, they get closed out. Is that correct?
You have hit the nail right on the head. That is exactly correct.
Okay, let's unpack this. The term we often use is actually killing those accounts.
This sounds a bit dramatic, but we are essentially zeroing them out completely.
Here's where it gets really interesting. We do this to start fresh for the next year.
What's fascinating here is that you use an opposite entry to make that balance hit zero.
So if a revenue account has a credit, you hit it with a debit to clear it.
Exactly. And all that data flows into a temporary holding pond called income summary.
Then it eventually makes its way home to retained earnings on the balance sheet.
This ensures our real accounts, like assets and liabilities, stay permanent and carry forward.
It's like hitting the reset button on a stopwatch while the total distance is saved.
If we connect this to the bigger picture, it's how the system maintains its integrity.
We really appreciate you sticking with us.
Hey, yeah, what's up?
So could you explain to me like this core framework, like the perfect equilibrium, regards to like assets equal liability plus
Oh, yeah, uh-huh.
assets equals liabilities plus equity?
You are so close. It is actually assets equals liabilities plus equity.
Right, that is the big one. We call it the basic accounting equation.
It is the ultimate anchor for every single thing we have discussed today.
Okay, let's unpack this. Why does it have to be a perfect equilibrium?
Because everything a company owns, those assets, must be funded by someone.
Here's where it gets really interesting. It is either from a debt or the owners.
Exactly. Liabilities are what you owe, and equities what the owners actually keep.
So it is like a scale that must always stay perfectly level.
If we connect this to the bigger picture, every transaction maintains this balance.
Even when we are killing those nominal accounts like we just talked about.
Precisely, because those revenues and expenses eventually flow right back into equity.
It is like a bakery. You have ovens and sour, which are your assets.
And you paid for them with either a loan or your own contributed capital.
What is fascinating here is that the double entry system is the tool for balance.
For every debit on the left, there must be a credit on the right.
So the equation stays in balance even if you are just horse trading assets.
This ensures that the fundamental equation remains unchanged after every single entry.
It is basically the law of gravity. Yep, go on.
Okay, well, the left side is the debits, right side are the credits. That's obviously the journal entry, how to do journal entries.
Spot on. You've got the directional layout.
Oh, back to our listener. What's up?
Okay, so this assembly line, in regards to like journalizing it,
Oh, yeah. Let's hear it.
journalizing these financial statements, and then what is the unadjusted trial balance?
Oh, go for it.
Actually, like, is the ledger, is that like the main thing?
Oh, yeah.
Is the ledger like this main thing, or is it like, can there be multiple ledgers? Like, as in like a ledger for
Yeah, let's hear
a
it.
ledger for like accumulated depreciation for truck A, and then like another ledger for accumulated depreciation for truck B.
Oh, you are really visualizing the gears of the system.
That is a fantastic question about how we organize all that data.
Okay, let's unpack this. There is one general ledger that holds everything.
Exactly. It is the master record for every single account in the business.
But inside that ledger, you would have separate accounts for every asset,
So Truck A and Truck B would each have their own specific accounts.
including those accumulated depreciation accounts you mentioned for each specific vehicle.
What is fascinating here is how the general ledger maintains the overall balances.
It is the final destination where all the journal entries eventually get posted.
And you mentioned the unadjusted trial balance earlier, which is the next step.
Right. Once everything is in the ledger, we run that trial balance.
It's just a big list to prove that your debits still equal credits.
It is the first.
Ah, yeah, uh-huh.
Okay, and then so like there's multiple ledgers with these journals,
Oh, yeah, uh-huh.
journal entries. These are like accounts.
Oh, go for it.
Like, how does that have to do with the trial balance? Like, I forgot.
We're thinking about those entries like individual trees in a massive forest.
It's a great visual. Each entry in those separate accounts is indeed its own little branch.
Okay, let's unpack this. The trial balance is basically like taking a helicopter over that forest.
Exactly. It's where we gather the final balance from every single one of those specific accounts.
So we take the balance for truck A and the balance for truck B.
And we put them on one big list to make sure everything balances out.
Here's where it gets real.
Oh, yeah. Go on.
Wait, is the trial balance like the income statement, or like the statement of cash flow, or like the balance sheet?
Okay, let's unpack this because that is a really crucial distinction to make.
What's fascinating here is that the trial balance isn't actually a financial statement at all.
Right, it is more like an internal checklist or a rough proof of your work.
Exactly. While the balance sheet or income statement are formal reports, the trial balance is for us.
Here's where it gets really interesting. It is just a list of all open accounts and their balances.
Its main job is simply to prove that your total debits equal your total credits.
So it is the step we take before we build those big statements you mentioned.
This raises an important question of accuracy, though, because it doesn't catch every single mistake.
Yeah, it won't catch if you put money in the wrong account as long as it balances.
If we believe this to the bigger picture, it's just the first major check in our assembly line.
So what is it?
Hey, yeah, what's up?
Okay, and then the adjusting entries.
Oh, yeah, uh-huh.
Like these adjusting entries, I forgot like what is
Yep.
exactly.
Go on.
I forgot exactly what. It's not a reconciliation of like bank accounts. What is usually the adjusting entries? Is depreciation.
Oh, back to our listener. What's up?
Like what is usually the adjusting entries? Is it depreciation?
You nailed it. Depreciation is actually a classic example of an adjustable entry.
It absolutely is. What's fascinating here is that adjusting entries fall into two big buckets.
Okay, let's unpack this. You have your deferrals and your accruals.
Exactly. Depreciation is technically a deferral because you bought the asset up front.
Here's where it gets really interesting. We're spreading that cost out over time.
Right, because the goal of these entries is
Oh, yeah. Let's hear it.
Okay, so like there's these contra accounts. Like for example, they accumulate depreciation, and they are added.
Oh, go for it.
They are added to the financial statements. Like for example, like the balance sheet or the income statement. But the thing is, like at the end of the accounting cycle,
Oh, yeah. Uh-huh.
at the end of the accounting cycle, these contra accounts have to be has to be closed. Have to be zeroed out. Another example would be like revenue, right? Revenue isn't a permanent what do you call it? A real account.
Oh yeah. Let's hear it.
Like revenue, like sales revenue is not a permanent real account.
Ah. Yeah,
Like
uh-huh.
sales revenue would be a nominal account. So like but it would be inside the financial statement.
Oh yeah. Uh-huh.
But it would be inside the financial statement. Like for example, that's a really important thing in like the balance sheet, or like for example, income statement,
Oh, go for it.
like the cash flow statement. So but the thing is, at the end of the accounting cycle, um, it's not really about creating like statements. It's more like balancing the books for next year.
Oh, yeah. Go on.
So then that account would have to be zeroed out. Like the sales revenue account would have to be zeroed out, or like the accumulated depreciation account would need to be zeroed out. Um, so like those would be
Hey, yeah. What's up?
those would be the closing entries. Is that correct? Like the zeroing out of these nominal
Oh yeah. Uh-huh.
these contra nominal accounts.
Oh, wait, I think we need to clear one thing up there.
Yeah, let's unpack this because it is a super important distinction.
You are totally right that revenue is a nominal account and gets closed out.
But here is where it gets really interesting. Accumulated depreciation is actually different.
What is fascinating is that even though it is a contra account, it is permanent.
So it does not get killed or zeroed out at the end of the year.
Exactly. It stays on the books to track the asset's total wear and tear.
Whereas revenue resets to zero so you can track the new year's sales fresh.
If we connect it to the bigger picture, only nominal accounts hit that reset button.
Right. Closing entries are the tool we use to reset that specific temporary clock.
These entries essentially bring everything current so the next operating cycle can start.
So your permanent accounts, like those trucks we mentioned, just keep their balances moving forward.
Precisely. The nominal accounts die off, but the real accounts live on.
Thanks for diving into those weeds with us. It really helps clarify the whole machine.
Yep. Go on.
So like, can you talk about the adjustments diagnostic matrix?
That matrix is essentially the blueprint for our adjusting entries.
Okay, let's unpack this. It basically breaks down into two big categories.
Exactly. We have deferrals and we have accruals.
Here's where it gets really interesting. Each of those has two sides.
What's fascinating here is that deferrals involve cash moving before the action.
Like those supplies or prepaid insurance we might buy for our trucks.
Right, or unearned revenue where you get paid before doing any work.
So the cash is already there, we just adjust the time.
Oh, back to our listener. What's up?
So is this cash based counting, or is this like accrual counting? Accrual counting. Like
Oh, yeah. Let's hear it.
a lot of times like there's like account receivables, like pretty much like IOUs between like companies, like suppliers. Is that like accrual based?
Oh, go for it.
Is that what it means? Or what does deferrals mean?
Oh, we are definitely talking about accrual basis accounting here, not cash basis.
Exactly, because cash basis is actually considered quite weak for modern business.
Okay, let's unpack this. What that means for your accounts receivable example is crucial.
In a cash basis world, you only record things when the hard-earned cash actually moves.
But with accrual basis, or what you called accrual counting, we care about timing.
What's fascinating is that accounts receivable represents value you've earned but haven't collected.
So the means here is that you're reporting the true reality of your work.
Precisely. While accruals are the opposite of deferrals, the action happens first.
Oh, like those interest payments or
Oh, yeah. Uh-huh.
So, like the statement of retained earnings, I've never heard of that. What exactly is statement of retained earnings?
Oh, that is a great question. Let's unpack the statement of retained earnings.
It is essentially the bridge between your income statement and your balance sheet.
Here is where it gets really interesting. It tracks the history of the company's profits.
Exactly. It is the collection of all net income minus any dividends ever paid out.
So it shows what the company actually kept or retained to grow the business.
What is fascinating here is that it proves your numbers before they hit equity.
It is like a running tally of a business's success over its entire existence.
This connects back to our accrual discussion because it reflects that true economic story.
Right. Like,
Oh, yeah. Let's hear it.
Okay, and like these nominal accounts, they come out of retained earnings.
Ah, yeah, uh-huh.
The nominal accounts get closed out from retained earnings. Is that correct?
You've got the right idea. I think you mean they get closed into retained earnings.
I love that. Retained earnings is like the home base for all those temporary nominal accounts.
Exactly. We use a holding pod called income summary to gather them all up first.
Okay, let's unpack this. The revenue and expenses fight it out in that summary account.
What's fascinating here is that the final net income or loss then marches into retained earnings.
So those trained armies of data finally settle down into the permanent equity of the company.
If we connect this to the bigger picture, it is
Oh, yeah, uh-huh.
So, cash-based accounting, I don't understand. What do you mean gap? It's not gap compliant.
That is a fantastic point to bring up as we wrap things up.
it really gets to the heart of why we use this whole complex system.
Okay, let's unpack this. GAAP stands for Generally Accepted Accounting Principles.
And those principles are all about transparency and the true economic story of a business.
Here is where it gets really interesting. Cash basis is like looking through a keyhole.
Exactly. You only see what happens when the literal cash changes hands.
But in today's economy, so much is done on credit and long-term promises.
What's fascinating here is that GAAP requires accrual accounting because it's more reliable.
Right. If you build a house in January but get paid in March, cash basis lies.
It makes January look like a total loss and March look like a windfall.
Whereas accrual accounting matches that revenue to the actual work done in January.
This is why we say cash basis is weak. It doesn't help investors predict.
Oh, go for it.
Yeah, so I understand. It's like when cash was received, based on compared to.
Oh, yeah. Go on.
Compared to accrual. Okay, well I guess that's the.
Hey, yeah. What's up?
Okay, that's probably it for now. Thank you. We could end the podcast.
It was such a pleasure having you with us today.
Seriously, thank you for all those incredible questions and insights.
You really help us peel back the layers of the accounting cycle.
Before we go, just to put a final bow on that gap point,
Right. The reason accrual is the gold standard over cash basis.
it's because the cash-only view doesn't help investors predict future flows
Exactly. It misses the bigger picture of what the company's actually owed.
and what it truly owes others, regardless of when the check clears.
That's the beauty of the system we've been unpacking with you.
It provides the most relevant and determinable information for the long haul.
We hope this deep dive into the AIS was helpful for your journey.
Don't be a stranger. We always love it when you chime in.
Keep exploring those numbers and questioning how the gears turn.
Take care, and we'll see you for the next deep dive.
Until next time, thanks for listening to our show today.